CarMax, the nation's largest used car retailer, just dropped a bombshell that's sending shockwaves through the entire auto industry. In a move nobody saw coming, CarMax has started slashing prices across its inventory, and analysts say this could be the beginning of a full-blown used car market meltdown. For years, used car prices have been inflated beyond reason, with pandemic-era shortages and high demand allowing dealers to rake in record profits. But what CarMax just did signals something far more serious. The bubble is finally bursting. According to reports from inside the company, CarMax quietly rolled out aggressive price cuts on hundreds of models nationwide, from budget sedans to high-end SUVs and even trucks that were previously selling at premium prices. We're not talking about small markdowns either. Some listings have dropped by thousands of dollars overnight. The company claims it's a strategic adjustment to align with market trends, but insiders and industry experts are calling it what it really is: a desperate attempt to clear aging inventory before values plunge even further. Here's where it gets wild. CarMax's latest earnings data already showed a worrying trend. Sales have slowed dramatically, inventory days are climbing, and consumer affordability is at its lowest point in years. With auto loan delinquencies rising and interest rates still hovering near two-decade highs, used car buyers are drying up fast. CarMax, which built its empire on quick turnover and fat margins, can't afford to sit on overpriced inventory. Their price cuts are a warning sign. They're anticipating a massive correction in used vehicle values, and they're trying to get ahead of it before the rest of the market crashes. This isn't just about one company making a few discounts. CarMax's pricing model sets the tone for the entire used car market. Dealerships across the U.S., from AutoNation to smaller independents, use CarMax listings as a benchmark for their own pricing strategies. When CarMax slashes prices, everyone else has to follow, or they risk being stuck with vehicles that no one's willing to pay inflated prices for. That means a ripple effect is about to spread through the entire sector, pulling down prices on everything from compact cars to luxury trucks. And the timing couldn't be worse for the rest of the industry. Over the last few months, used car prices have already been softening, but CarMax's move could turn a slow decline into a free fall. Analysts from Cox Automotive recently warned that wholesale auction values are dropping faster than expected, and many dealers are already sitting on vehicles that are losing value every week. By cutting prices so aggressively, CarMax may have just accelerated a collapse that was already in motion. But what's driving this sudden urgency at CarMax? Some insiders suggest that it's more than just slowing sales. It's also about financing risk. With the average used car loan payment now well over $550 per month and default rates climbing, lenders are tightening standards. That means fewer approvals, smaller loans, and more trade-ins being rejected. For CarMax, which relies heavily on financing partnerships, that's a disaster waiting to happen. The only way to move cars is to make them cheaper, even if it means taking a hit on profit margins. Meanwhile, consumers who overpaid for vehicles in the past 2 years are now watching their cars lose value at record speed. Trade-in values are plunging, and many buyers are finding themselves underwater, owing more on their loans than their vehicles are worth. If CarMax's markdowns continue, that problem will explode across the country, creating what some analysts are calling a reverse gold rush in the auto market. Instead of fighting to buy cars at any price, people may soon be scrambling to sell before values collapse entirely. The question now is, did CarMax just pull the trigger on a market correction everyone's been dreading? Or are they simply the first domino to fall in a chain reaction that's been building for months? Industry experts are split. Some believe CarMax is being smart, cutting prices early to regain momentum and move volume before things get worse. Others warn that this is a sign of panic from a company that sees what's coming and is trying to offload risk before it becomes unmanageable. Whatever the case, one thing's for sure: when the biggest used car retailer in America starts slashing prices like this, it's not just a sale, it's a signal. And if history is any guide, this move won't stay contained to the used car space for long. New car dealers, already struggling with high inventories and slow demand, will feel the impact next. After all, who's going to buy a new $45,000 SUV when CarMax is offering nearly new versions for thousands less? Automakers like Ford, GM, and Toyota have been banking on high transaction prices to stay profitable. But that strategy could crumble fast if consumers shift back to used cars at lower prices. And with CarMax effectively resetting the pricing floor, that shift may already be underway. What's even more alarming is how this sudden price drop exposes the fragility of the entire automotive ecosystem. For months, automakers and dealers alike have been trying to maintain the illusion of stability, holding prices high to protect margins and prevent panic. But CarMax just shattered that illusion. Their markdowns confirm what many insiders have whispered privately. The market is oversaturated. Consumer demand has CIC. Think about it. During the pandemic, CarMax and nearly every other dealer enjoyed a historic run. Inventory shortages allowed them to charge sky-high prices for cars that would have been half as valuable in 2019. Vehicles were flying off lots, and even 10-year-old sedans were commanding ridiculous premiums. But now, as supply chains normalize and consumers face higher costs of living, the party is over. CarMax's new pricing strategy acknowledges that reality, and it's forcing everyone else to face it too. Inside sources say the company has been sitting on record inventory levels, with some lots overflowing and vehicles sitting unsold for months. The longer they wait, the more those cars depreciate, especially as 2025 models hit the market with steep incentives and new tech. CarMax knows that once depreciation kicks in, the value of its entire stockpile will erode like sand slipping through fingers. So the decision to drop prices isn't just about gaining market share, it's about survival. They're trying to unload inventory before it becomes a financial sinkhole. And while this may look like a smart business move for CarMax in the short term, it's a nightmare for everyone else in the used car space. Smaller independent dealers don't have the financial cushion or nationwide network CarMax does. When they're forced to match these new lower prices, many will be selling at or below cost. It's a race to the bottom, and the weakest players won't survive it. This could lead to a wave of dealership closures over the next year, a used car recession that reshapes the entire industry landscape. But there's another deeper layer to this: the consumer psychology shift. Over the last few years, people were conditioned to believe that cars were appreciating assets, that if they bought today, they could sell next year for the same price or even more. CarMax's drastic cuts destroy that belief. Once buyers realize prices are falling again, they'll hesitate to purchase, expecting better deals later. That hesitation kills demand even further, feeding a downward spiral. It's the same dynamic that hit the housing market in 2008, and this time it's playing out on four wheels. Some industry watchers are already calling this the start of a deflationary loop in the auto sector. Dealers slash prices to spark sales, but consumers wait for even lower deals, forcing more cuts, more losses, and more panic. And the Federal Reserve's high interest rates are only pouring fuel on the fire. With financing costs soaring, even a $3,000 price drop isn't enough to offset the pain of 8% to 10% auto loans. That means fewer qualified buyers, longer listing times, and mounting financial pressure for dealers and lenders alike. Meanwhile, the used car financing bubble is beginning to burst. Subprime auto lenders who have been approving risky loans at record pace are now facing surging delinquencies. Many of those loans were tied to inflated vehicle values from 2021 and 2022, values that no longer exist. If prices keep falling, lenders could be left holding billions in collateral that's worth far less than the loan balance. This is exactly the kind of chain reaction that can trigger a full-blown financial crisis within the auto sector. And here's where things get really concerning. CarMax's move could be a preemptive strike against what they know is coming next: a wave of repossessions. As more borrowers fall behind, banks and credit unions will flood the market with repossessed vehicles, further swelling supply and driving prices even lower. CarMax might be cutting early to avoid competing with that tidal wave of cheap repos that's likely just months away. If that's true, then we're looking at a perfect storm. Oversupply, collapsing prices, and falling demand all hitting at once. So the question now is, how far will this go? Are we looking at a short-term adjustment, or the beginning of a long, painful crash that reshapes the entire used car industry as we know it? Because once confidence disappears, recovery doesn't happen overnight. It takes years for markets to rebuild trust, and with new vehicle sales also slowing, Automakers could soon feel the shockwaves CarMax just unleashed. And as the dominoes start to fall, the effects are spreading far beyond dealership lots. Rental car companies, fleet operators, and even automakers' certified pre-owned programs are suddenly finding themselves in trouble. Many of these companies built their 2024 financial projections around stable or slightly declining used car prices. Not the kind of steep, across-the-board collapse that CarMax's move could trigger. The moment these prices begin to reset, it creates accounting chaos. Assets they counted as stable suddenly lose value, forcing write-downs and squeezing balance sheets. For example, Hertz, which already faced bankruptcy once during the pandemic, relies heavily on reselling used vehicles to manage its fleet turnover. If the resale values drop sharply, their entire business model takes another hit. The same applies to rental firms and leasing companies that plan to offload thousands of vehicles this winter. They'll have to sell for much less than expected, losing millions in residual value. And that's not even considering the automakers themselves. Companies like Ford and GM that use their captive finance arms to lease new cars will now have to absorb losses when those leases expire and vehicles return to market at lower values. This ripple effect could hit Wall Street next. Investors have long treated CarMax as a bellwether for consumer demand in the auto sector. When CarMax stumbles, it's often a sign that broader spending patterns are shifting. If this price drop signals weakening consumer confidence and overextended credit markets, we could see a much larger correction, not just in auto stocks, but in related industries, insurance, lending, and logistics. Think of it as the auto industry's version of a credit crunch, where every piece of the puzzle starts to feel pressure simultaneously. But make no mistake, CarMax's leadership knew what they were doing. This wasn't a random decision. Reports suggest that the company has been preparing for months, quietly testing localized price reductions in certain markets to measure consumer response. What they found was clear. At current price levels, cars simply weren't moving. The demand elasticity had snapped. Consumers were no longer willing to overpay for aging inventory, especially with new car incentives returning and EV prices plummeting. So CarMax made the bold call to go national with the markdowns. It's a shock tactic, a way to jolt sales back to life, even if it means sacrificing short-term profits. And ironically, this could temporarily work in their favor. Lower prices mean faster turnover and fresher inventory, which is critical heading into the winter slowdown. But the broader impact is catastrophic for competitors. Smaller dealerships can't afford to keep up with CarMax's scale or efficiency, and they don't have the same access to low-cost financing. Once CarMax resets the pricing floor, these smaller players are forced into a corner. Either sell at a loss or watch inventory sit and rot. For many, that's not a choice at all. Expect bankruptcies and consolidations to rise dramatically in 2026 if this trend continues. Meanwhile, buyers watching this unfold are now caught in a tricky situation. Do they buy now and take advantage of CarMax's price cuts, or wait for even steeper drops? Historically, when a major retailer like CarMax initiates a market reset, prices continue falling for months afterward. That's because once a decline starts, confidence evaporates, and dealers panic sell to keep cash flowing. In other words, what we're seeing right now might just be the beginning of the slide, not the bottom. And here's where things get even more interesting. CarMax's aggressive cuts could actually pressure automakers to accelerate new car incentives to stay competitive. In recent months, brands like Ford, Hyundai, and Stellantis have quietly begun offering larger rebates and lower financing rates to move metal off lots. But now, with used car prices falling fast, those incentives may not be enough. Imagine trying to sell a new Ford Escape for $36,000 when CarMax has nearly identical one-year-old versions for $24,000. Dealers will have no choice but to discount harder, pushing automakers to respond with bigger rebates. And that could wipe out profits across the board. This is how a retail pricing adjustment turns into a full-blown industry crisis. Once pricing pressure begins at the bottom of the pyramid, it climbs upward, squeezing everyone from local dealers to multinational manufacturers. And with EV prices already in freefall thanks to oversupply from Tesla, BYD, and others, the traditional internal combustion market is about to get hit from both sides. The entire pricing structure of the auto industry is destabilizing at once, and CarMax may have just lit the fuse. And as this fuse burns, there's growing concern that CarMax's decision could mark the turning point for consumer perception in the car market. For years, Americans were told that cars, especially used cars, were appreciating assets, a rare anomaly caused by pandemic supply chain chaos. But that illusion is evaporating fast. People are realizing that cars are once again depreciating machines, and that realization could reshape how consumers approach car ownership altogether. We're already seeing early signs of this shift. More buyers are holding onto their vehicles longer instead of trading in, waiting out what they believe will be a deeper price correction. Some are even choosing to downsize, moving from large SUVs or trucks to smaller, more affordable options to avoid steep losses. And then there's a growing number of people choosing not to buy at all, instead relying on rideshare services, leasing, or simply delaying major purchases until the dust settles. This behavioral change, once it takes hold, could drag down sales across the entire automotive sector for years. CarMax's price drop didn't happen in isolation, but it's also a reflection of broader economic stress. Inflation may have slowed on paper, but the cost of living remains painfully high. Wages haven't kept up. Credit card debt is at record levels, and the average household is running out of financial room to breathe. Buying a car, new or used, is now one of the biggest monthly expenses most Americans face. Combine that with 8 to 10% interest rates, and you've got a perfect recipe for collapsing demand. CarMax simply responded to the reality that millions of potential customers have been priced out of the market. But the company's move might also be a strategic gamble for dominance. If CarMax can weather the storm, while smaller competitors crumble, they could emerge stronger than ever. Think about it. As independent lots close and franchise dealers pull back, CarMax could seize an even larger share of the used car ecosystem. With its nationwide logistics, financing network, and brand recognition, it's positioned to outlast most rivals. So, while the price cuts may look desperate, they could also be an aggressive play for long-term market control. A calculated sacrifice today for monopoly-like power tomorrow. At the same time, Wall Street is watching CarMax's every move with mixed emotions. Investors love growth and market share, but they fear falling margins. And CarMax's latest reports already show shrinking profits per vehicle sold. If this trend continues, analysts may start downgrading not just CarMax, but the entire used vehicle sector. That could send ripples through auto stocks, financing firms, and even automakers' supply chains. Because once the financial markets lose faith in automotive stability, credit tightens, liquidity dries up, and the cycle of decline accelerates. And let's not forget, the used car market doesn't exist in a vacuum. Its health directly affects new car sales, leasing values, fleet operations, and even manufacturing output. If prices crash too quickly, automakers could respond by cutting production, just like they did in 2008, to prevent new models from flooding a weakening market. That means layoffs at factories, reduced orders for parts suppliers, and ripple effects through logistics companies, shipping ports, and even semiconductor suppliers. The last time something like this happened, it took nearly a decade for the auto industry to recover. But there's another side to this story that no one's talking about yet: the impact on electric vehicles. With used EV prices already down more than 30% year over year, CarMax's broad market price drop could make that crash even steeper. Many EVs that once sold for $50,000 to $60,000 are now struggling to fetch half that on the used market. If CarMax accelerates markdowns on EVS2, we could see a mass devaluation across the entire electric segment, especially for older models with limited range or outdated software. That would devastate resale values and potentially slow EV adoption in the short term, as buyers grow wary of losing thousands in depreciation. Meanwhile, the average car buyer, the everyday American just trying to make ends meet, might finally catch a break. For the first time in years, there's real hope that used car prices could return to something resembling normal. Vehicles that were wildly overpriced during the pandemic are suddenly becoming affordable again. That could breathe life back into segments like first-time buyers, students, and families who've been locked out of the market. But even this silver lining comes with a warning. As prices fall, trade-in values plummet, leaving many owners upside down on their current loans. So while new buyers might win, current owners could face serious financial pain.